On to a special conversation on Talking Point today. The Bandhan think tank with us, Bandhan AMC think tank. Vishal Kapoor, CEO, and Manish Gunwani, Head of Equity at Bandhan AMC, join us right now in our studios. Well, congrats guys, as you finished 25 years, so it's a milestone of sorts, and we'll get to that too. But can I start off with talking about how do you guys see risk assets in the current context? Simply because, last week we had a couple of very bullish voices who said that India looks rock solid, earnings recovery on the anvil, and this is the quarter that marks it. And the underpinning of all of this activity is the kind of flows that Indian investors are putting into Indian mutual funds. So let's start with that. Vishal, can we start on that?
Well, certainly, I think the flows have been strong and continue to be strong, as we are seeing. And I think, at some level, you have to appreciate the maturity that retail investors have been showing, because if you look at the flows, a lot of it it's actually dominated by SIP flows, which is what we really like. So it's not really lumpy money and tactical allocations, which is largely drawing, this sort of momentum. It's really retail money spread across a full range of product types, which is driving it. So it's very granular, which is what gives us a lot more confidence. In terms of the market's ability to absorb and therefore our valuations, right, I think Manish will be better positioned to comment. But we have to look at it in perspective of the overall size and scale of the next 5 to 10 years. So it's really what do you expect over the next 5 years? What are your alternatives? And is this still a growth asset that you'd like to back in relation to others? So if you're a retail saver and you're splitting money across different asset classes, are we still overweight equity? And I think macro numbers tell us, no, we're not. Most investors are still underweight equity, most retail investors, that is. And therefore, a bit of allocation into equity through mutual funds, I wouldn't think is so worrisome. But anyway, I think valuations, Manish is the guru.
You want to come in on that? I agree completely. Manish is the guru on valuations for sure. But I heard Manish say right at the start of the conversation that maybe small caps are also not a worry thus far, right? So Manish, come in on the valuations. Are you constructive? Are you not? Why or why not?
Look, the standard way to look at it is people are looking at Nifty 100p and saying, oh, it's 10-15% higher than last 10 years, right? So first of all, I don't think Nifty 100 is the core of this market, right? Second, when you see the valuation in context of the macro, especially the currency dynamics, right? I think probably India's currency has never been as good as this since independence, because first time you're virtually 0% current account. Never happened in India, right? So when you have a country which is moved from a chronic current account deficit to a structural, let's say almost zero current account, the cost of equity will go down. So these high P multiples, to my mind, will sustain on a cycle basis. We will have 6 months of corrections, we will have 6 months of market going up. But if I take, let's say, next 5-10 year average P multiple, I would submit that rupee assets will trade at a higher valuation than last 10 years. Because your cost of equity for a good company was 14%, for example, now it's 12%. Because the currency was depreciating 4-5%, now it's going to depreciate 0 to 2%. So I think you have to see it in context of that your discounting rate, as we say, the most fundamental way to value equities is discount the cash flows. So if the denominator goes down, the P multiple goes up.
Manish, are you seeing expectations also pairing? I'm talking about the flow of when your SIP started building up, people came in with a certain of expectations of what their equity portfolio would bring them. Those days seem to be behind us for now, if I look at the last year or so. Yeah. Are expectations pairing? Are you feeling that pressure to go out and find those kind of returns, or how do you look at that scenario?
Yeah, as Vishal mentioned, I think the system is becoming more mature. So let's say 10 years back, if your nominal GDP was 13-14% because your inflation was 7-8%, now your nominal GDP is 10%, inflation is 4%. I think people are realizing that the default return on large cap is 10-11, not 14-15. It has to be, right? I mean, basically, the large caps over long term will always give you nominal GDP, broadly. Right?
So expectations are pairing,
I think so.
Even from small caps?
See, small caps, you expect alpha.
Yeah.
So you expect that they'll beat large caps on a 3-5 year basis. I think that's a fair expectation to my mind.
To your point to that, because I think expectation matching is a challenge for your space in that sense. People have kept up with their SIPs, yes, but then you saw all the froth in thematic and then small cap. Are you seeing a shift in sort of mood there?
So it's certainly something that as an industry we look at closely in terms of moderating expectations, because and let's recognize, like the index, the market is not homogeneous, and similarly investor behavior is also not homogeneous. So there can always be one end of the market which is very tactical, which is looking at last 6 months, 1 year return and jumping in because that's what you want. And there we keep, sharing, communicating, advising that please don't, use this as the parameter for what you want to expect in the future. But I think the larger market is definitely a lot more resilient, a lot more mature. And that's what we mean by seeing the breadth of the exposure. So yes, there was some amount of flows, maybe getting too concentrated into thematics, into sectors, and we see so much volatility in sector rotation now, which gets you thinking that are people coming in for the wrong reason? There's something all of us should worry about. But when you see behavior over time, of course, there's always maybe 15-20% of the market which is showing that behavior, but the bulk of the market, I think, is still in a reasonably good place.
Settling. That's good to hear, actually. Just coming back to the here and now, Manish, if you can come in on what you were seeing at early days, but you talked about valuations, and in that context, earnings, because you spoke about PE multiples as well. Yes, broadly, current account, get that picture, but companies have to report earnings that hold up finally, and we're still waiting for that to happen. Last we heard Q1 was going to be that quarter. Not so sure right now. What are you thinking about this?
Again, I think we should be realistic that last 5 years, let's say from COVID to 2025, the Nifty earnings broadly have done about 17-18% annual growth rate. Now, when you grow so much above nominal GDP, you tend to converge back. So I don't think we should expect Nifty 100 earnings to grow at 15-20% for another 5 years, right? It's very difficult. And even bottom up, if you see, let's say the largest constituent banks, they got a big uplift last 5 years because credit costs came down from, let's say, 1.5% to 0.3, 0.5%. You don't get that uplift going forward, right? You probably get a negative effect of credit costs going up, actually. So the whole point is, I think the large cap segment is obviously a mature segment, fairly reasonably valued, give you steady returns. I don't think we should expect them to have gangbuster earnings. I think as I said, if you have a 3-5 year time frame, it's the change you play in this economy, which is happening in smaller cycles, smaller companies. That's the way to create alpha, to my mind.
So therefore, the question will be that what are those themes, right, that come to? And actually, the AMC question to Vishal, you would be, would we see a lot of thematic fund launches coming out? Because there are some, like maybe 15 sectors created in the last 4 years in the Indian markets alone, right? And some of them have become very large. Do we see a lot more thematic funds coming out? Are you guys planning something?
So look, thematic funds, when we look at it, we are really looking at, like Manish mentioned, what's the investment thesis? And for that investment thesis, if we don't have something that really fits that specific idea, is there room for another idea is really the one way to think about it. And then when you put it out, you see if there are enough investors who believe in that thesis, and then therefore they want to back you with returns. Certainly not something that you want to do just because something is played out, because as we all understand, cycles will go up, but it will come down as well, and therefore the peak of the cycle is something we have to worry about. Now, while that is something at a tactical level, at a day-to-day level, one will always look at, clearly that is for a lot more of an evolved investor. Someone who's got a good stack of broad-based funds and is now looking for what is called the satellite or the alpha part of the portfolio and looking for something more because you're okay with the bread and butter. But I still want to go back to the bread and butter. There is just so much more opportunity. And I think, since we are celebrating our 25 years, it's a point in time when you look back and say, look, let's look at where we were in 2000, which is when we started, and where we are today. And sometimes times like this forces you to reflect on therefore what the next 25 could be or the next 10 could be.
So let me ask you on that, and then I'll ask Manish broadly about the themes, but you are not listed. So therefore I'm able to ask you that, do you think the AMC industry earnings, you're running an AMC, can they grow at a particular CAGR rate for the next 5-10 years as ETFs and fixed price and lower margin products come and take center stage, right? Geo, BlackRock, etc. are doing that. Do you believe there are enough levers for an AMC to do that? Because that industry is still nascent, right? I mean, you guys are still kind of expanding meaningfully.
Right. And
so you will your last 5 years out of your last 25 years mirror what you do in the next 5-10 years?
Right. So I think we are a very competitive industry. So while the number of players may have remained, in a broad band, and now we are seeing some real growth happening in terms of number of competitors, but actually the competitors, the intensity is very high, which means that yes, while it's a very high growth industry, growth is not available to everyone. You really have to be sharp and at it, and any slippage will get punished, and any outperformance will get doubly rewarded in a sense. So clearly, if you can sustain that performance, sustain that momentum, then the reward could be outsized. Because let's understand that this is also an industry, despite margins coming down, which is what I think, like any mature industry, you should anticipate, that margins over time will come down with scale. Operating leverage can be quite high. So in this industry, I think it's high growth, but it's also very competitive, which means that the winners get rewarded quite handsomely. But margins are coming down. I think with competition, that's great for investors. And therefore, you have to balance out between profitability and growth.
Do you see a disruption with the Geo BlackRock model coming in? I mean, the buzz that they will do to the AMC industry, what happened to the telecom industry?
Yeah. So I think there's anticipation, but to each his own. And one would also argue that yes, whatever Geo can do or BlackRock can do, why won't the incumbents also not be able to do it? It's not locked out. So if you are doing something and you're good at it, what stops you from doing that as well? So if largely the expectation is passive products direct to customer, yeah, passive products direct to customer is also what many large AMCs, including us, do. So there is a website, there are index products, there are passive products that people. So end of the day, I think it is great for investors because there is more to choose, there's more competition, but it's not so straightforward that just because you can deploy capital or anything else. End of the day, I think the overall package of performance, service, continuity, stability, trust, all of this really plays out.
Themes from Manish.
Yeah, as we wrap up. Yes.
Themes, Manish. You mentioned small caps, you mentioned about a lot of sectors. Vishal mentioned that. What do you like?
So there are 2 or 3 medium to long term themes. One is, I think affluent consumption will do very well. I am not so hot on penetration led consumption because I think slowly India's demographics is also peaking out, especially in the richer states. So we like real estate, aviation, where people will migrate and premiumize in that sense. So we like anything where top 5, top 10% are consuming, and more people will join that cohort. Second is, I think India will become a big hub for medium to high-end goods and services. Manufacturing, engineering goods, pharma, contract research, which is, you also see these GCCs mushrooming, right? Because the West has an aging population where trained people are difficult to get. China +1 is there. So we like all these segments where someone's doing something with engineering, someone with some R&D, right? Not mass manufacturing because that is getting automated, but you need a bit of moat in manufacturing. And thirdly, it's financialization, right? I think people will move away from, let's say, a savings account to more capital market-oriented products because you get 2.5% in savings account, right?
Yeah.
I mean, it's a bit of lazy money, isn't it? And post-tax, even the retail FDs are not covering you too much versus inflation, right? And on full tax rate, you're probably getting 4.5%, 5%. So you're not making any real return, right? So I think people will obviously, with all these apps and all that, people find it easier to move money around, right? So those are kind of three themes which I think will do well.
So, you know, interesting, focusing on the top tier of the Indian economy, the creme de la creme, and their spending. That's what everyone's been talking about. What about the rest of the massive pyramid?
I think people will migrate because see, the balance sheet of Indian households is super strong to my mind. I think we have $2.5 trillion of gold, right? And with your population close to peaking out in the richer states, the amount of net worth per kid is actually very high. So you see the demand for aviation, for example, even other consumption items do up and down, but it's holding steady, right? Because people want to move up
the ladder.
Move up the ladder, right?
Yeah. All right. Thank you so much. Absolute pleasure. And thank you for coming in and speaking with us here in our studios.
Thank you, and thanks for having us.
Thanks
a pleasure.
And congratulations on 25 years. Wish you many more.
Thank you.